Okay. Well, we started now. Net income of $28.60. Depreciation expense. Good question. So depreciation expense is what happens when we have machinery, equipment, vehicles, computers, buildings, when they lose value over time. So if you think about, you buy a new car. Has anybody bought a new car lately? Because they're kind of expensive. My sister was visiting over the holidays, and she went and looked at a new Mustang Mach-E. So let's say you bought a new Mustang Mach-E, and they're, I don't know, $45,000 on up. So you buy one of those, you drive it home, and you're like, 2 months later, I don't like it. I hate it, whatever it might be, and you want to sell it. Are you going to get your $45,000 for it? Typically, no. I mean, used car prices are really high right now, but typically you wouldn't. You would get significantly less, and that would be depreciation. So it's a loss of value. That's technically not the definition. It's a systematic allocation of the cost of an asset over its useful life in a rational and systematic manner. But I liken it to loss of value and how we capture that. Does that make sense? Hopefully. Awesome. Okay. All right. So on our income statement, Sierra Corporation made $2,860 in the month of October. Now we need this number. That's why we prepare the income statement first. And I think I have one here. Great. This is Home Depot's income statement. Now it's called the Consolidated Statement of Earnings because it's for all of the entire organization. Think about it. It's the entire Home Depot summarized their income in what? I don't know, 20 lines there. It's a very summarized. They don't want to share too much detail with the public, particularly their competitors as well. So it starts with net sales, which is, again, when you walk into Home Depot and you buy something, the amount that you would pay minus any returns or what we call sales returns and allowances. And then they subtract out cost of sales. So there's the cost of their merchandise, and they get something called gross profit. And we will spend some time on this later in the class because that gross profit is really important number. They need enough gross profit to pay all of their other expenses after they pay for just their merchandise. So what's interesting about Home Depot here, you can see from 2018 to 2019 to 2020, their gross profit has been steadily increasing, as is their net sales. So that's something you would want to see. If you're a manager of a company, you're constantly pushing your employees to be better and better, and you always want higher net sales. Everybody always wants higher sales. And then you can see their expenses. So we'll just look at the line right here, and their expenses were also increasing. Well, that's in and of itself not a terrible thing because as their sales increase.
I'm having trouble hearing you.
Sorry, me too. In and of itself, having higher expenses when your sales are increasing isn't terrible. What we would look at then is their operating income, and is it also increasing accordingly? And ever so slightly, yes, it was increasing. And then we can come down here to their net, which would be like their net income after some other items like interest and taxes. And again, they have a steady increase there as well. So just to show you, even from a 30-minute conversation, you can kind of see what we've been talking about here. It's not probably the clearest example, but yeah, it's pretty straightforward. We'll take a look at their balance sheet in a minute, which is probably more similar to what we will discuss here. Any questions? Okay. All right. Statement of retained earnings. Again, think savings account. Yeah, the slides should be on Canvas. Let me take a quick look. Under modules, let's see. If you look at the Start Here tab, There's a tab called PowerPoint slides, and you can find them there. Yeah, they should be on a zip. You know, you might not like me for that, but I know when I was a student, I thought it was really monotonous to have to download each and every chapter. So I just zip them and give them to you, and you can open them yourself. So retained earnings statement. Again, think savings. And accountants aren't very creative. Retained earnings. It's earnings they've retained in the business that they didn't spend. Start with your header again. This happens to be for the month ended October 31st as well. Start with the beginning balance. So look and see, what is the month ended October 1st? When would the beginning of that period be? And in this case, it's October 1st. It starts with 0. So either they're a new company or they didn't have any retained earnings. Add that 2860 from our income statement. Go ahead and subtract $500 in dividends, and we get our ending balance in our statement of retained earnings of $2360. Okay. Now we need this number for our balance sheet. So this one always carries the same basic format. Those 4 items that you see. The only difference might be if we didn't have net income, we would have to subtract the net loss. So there would be no net income to add. We would be subtracting the net loss. All right, let's take a look at the balance sheet. The balance sheet we've somewhat covered already, quite honestly, because the balance sheet is basically our accounting equation. It's going to show us the assets, and they have to equal the liabilities plus equity. Hence, we get that balance. Kind of think of that scale where you put things on it, and it, like a teeter-totter. Is that what they call it? A teeter-totter. It's been a long time. Also, if you drink too much ale, the alcoholic kind, you lose your balance. So that's another way to remember what goes on your balance sheet. And we've already, again, covered assets, liabilities, and equity. What I want to point out here, this 21 total assets has to equal total liabilities and stockholders' equity. If those two numbers don't equal, you made a mistake and you have to go back. But let's back up just a minute. So they would list out all of their assets. This particular company on October 31st. So it's as of a specific date. It's a snapshot. Here's what my assets are. Here's what my liabilities and equity are on that specific date. So on October 31st, this company has cash of $15,200. They are owed $200 in accounts receivable. Their supplies are $1,000. They have prepaid insurance of $550, and they own $4,960 in equipment for total assets of $21,910. On those assets, they owe $5,000 in a note, so they have a loan for $5,000. Their accounts payable, they owe $2,500 to their suppliers. Their interest payable is $50 that they owe. Unearned revenue, so they have received money up front. Now they have an obligation to provide a service or deliver merchandise of $800. Salaries payable is $1,200. So their total liabilities, $9,550. We've got common stock and retained earnings. They have $10,000 of stock outstanding. Their retained earnings was $2360. Again, remember we calculated that in the last financial statement. So we add the $9,550 plus the $12,360. And we get $21,910. Questions on that one? Balance sheet. Again, it tells us what do we own, what do we owe, and what is our equity. I might have to close my door, sorry. Okay. Let's see, I might have Home Depot's. There we go. Sorry if it's a little small for you. I think you can zoom in if you want. I'm just going to point out a few things. Assets. Then you'll see liabilities and equity. And right under assets, you'll see the word current assets, and you'll see total assets, $70,586. Will we have templates, or will we be making templates? Will we need to create balance sheets? Yeah, I think in your first homework assignment, you will create a balance sheet. So yeah, in My Open Math, you have a form that you are going to complete. And again, give it a shot. Use your 3 attempts. You can view the jump to the answer and restart with a similar question. The quizzes are more like true, false, multiple choice. So the quizzes, the homework has you apply what you're learning, and the quizzes are more conceptual. Kind of, do you understand and can you apply the terms and concepts? So they actually assess you on different things. I would probably recommend doing the homework first, so you're applying it, and then tackle the quizzes. It may be a little easier to take that approach. And just to point out, in your financial analysis assignment, which I don't have due until week 6, but you can probably complete after next week if you would like, you will do some like we're doing right now. So I will give you financial statements. I will give you Ford and GM and Home Depot and Lowe's, and I'll be like, what is the total asset? So you have to come here and you find the word total assets and you scroll over, and then you're going to grab that number and you will enter it. So you're asked to kind of familiarize yourself with these financial statements and hopefully take some of the mystique away from them and make them less intimidating. Because when you kind of start to break it down, there's the word current liabilities, total liabilities. They aren't really as probably complicated as they look initially. So that's one of the things I really want you to take away from this class, because you can use this if you're investing, and that's important for you all. I want you all to have lots of I don't want to say some familiarity anyway. If you want to do some investing in your personal life, you can analyze some of these financial statements. 2 attempts for question homework. You actually get 3 attempts, and then you can redo that problem again with a different set of numbers, and you get 3 more attempts, and you can redo it again, 3 attempts. So you get an unlimited amount of attempts, quite honestly, but only 3 attempts before you get the solution and you have to start over. So yeah, lots of opportunities to complete each one successfully. All right, the 4th financial statement is called the statement of cash flows. This is kind of like the stepchild of the financial statements. This didn't come around until 1987, somewhere around there. It wasn't a formal financial statement, but it just tells us what happens to our cash. Where did we get our cash, and what are we spending our cash on? And there's 3 components to the statement of cash flows, and it's really enlightening. I don't think we in this class will probably spend a lot of time on the statement of cash flows, so I'm just going to kind of quickly review those sections with you. But it has 3 sections you see here: operating, investing, and financing activities. So the statement of cash flows, again, is going to tell us where is the company getting its cash and what is it spending it on. Does it have is it making payments? Are they borrowing money? Are they earning all their cash in their business operations? What is it spending them on? Things like that. So it is pretty enlightening and kind of important. So when it says operating activities, we're talking about the everyday business activities of the company. So those revenue and expense generating activities. What is it doing every day in its business operations to generate cash? What is it spending? What expenses is it spending it on? And that's what we're talking about for operating activities. Those investing, let me back up. Those investing activities deal with our long-term assets. Yeah, have to really push. Long-term assets, things like property, plant, equipment, machinery. You see here a whole list: computers, furniture. So with investing activities, we would have an outflow of cash if we buy some long-term assets, and we would get an inflow of cash if we sell them. And we need long-term assets to run our business in most cases. Financing activities, these are obtained from outside sources, people outside of the company. We would be getting cash through financing sources. That would be our lenders and creditors, or our investors, people who are investing in our company and we're giving them common stock. So the way that we get cash from a financing activity is we take out a bank loan or we issue stock. Ways that we have an outflow of cash from a financing activity: would be if we are paying out dividends to our stockholders or we're paying back some of those loans. And here's what a general statement of cash flows look like. So you can see we have cash receipts and cash payments from operating, investing, and financing activities, inflows and outflows of cash. Inflows would be positive, outflows will be negative. And then we add operating, investing, and financing activities together to get a net increase or decrease in cash. And this number you see matches what we saw on our balance sheet for cash. And again, the statement of cash flows, as far as this class is concerned, is probably the least important. The primary ones that we were most interested in are the income statement and the balance sheet. So that really is it for, here's a statement of cash flows for Home Depot. Just so you see, cash flows from operating activities, cash flows from investing activities, cash flows from financing activities. So we've got those three primary headers. And again, you can see changes in different types of accounts. I'm not going to go into much more detail than that, just so you understand. It's telling us what's happening with our cash. This just talks about the relationship and how we have to do the income statement first, because that income flows to our statement of stock, our retained earnings, which flows to our balance sheet. And then the balance sheet cash account flows to our statement of cash flows. So any questions on that? Because I think we will take a quick break and we'll move to the next chapter, and I'm going to get you guys involved now in our next discussion. So you have, and we could prepare those, but I want to wait and make sure we get through all of the next chapter first. Any questions? Okay. All right. Why don't you guys take 8 minutes. We'll come back at 6:55 and we'll take over with the next chapter. And like I said, I want to get you all involved. I'll ask you some questions on the next one. Okay.
Sounds good.
Great. I'm going to pause the recording. Remind me to restart it. Do something called closing entries, prepare post-closing trial balance, and then I don't do reversing entries, so you can ignore that. So that just gives you an idea. Let's see. For expense recognition, did I say to record it when it's due? So we recognize the revenue when it's been earned and the expenses when incurred. It doesn't matter when we receive or pay the cash. That's why it's when it's earned, when we've delivered the merchandise or provided the service. It doesn't matter when I get cash for that. Same for expenses. When I incur them, I record them. It doesn't matter when we pay them. That's what those, whoopsie. That's what these two mean, revenue recognition and expense recognition. Okay. So again, fundamentally, every business will have something called a chart of accounts. And this is just a listing of all the accounts that they use to keep score and keep track of what's transpiring in their business. So you can see the listing of account names, and each account will get assigned an account number. You'll happen to notice perhaps that the assets get listed first. Then we tend to list our equity accounts, our liabilities, and then our equity. And then we will keep track of what happens to all of our different accounts in something called a ledger, the general ledger. And I'll show you all of that here in just a minute, how that process flows. So if I'm analyzing a transaction and I want to record it, I have to look and see what account that the business is using. I can't just make them up. I can only use the accounts that are already pre-established for that business. And this is really important here. So in its kind of most simplistic form, we can break up an account into what's called a T account. And you can see that T right here. we do something like this. So at the top, you would see the title of the account. So we might list cash or accounts receivable or equipment. And then we have a left side and we have a right side. The left side is known as the debit side. The right side is known as the credit side. And if the debit side carries more than the right side, we carry what's called a debit balance. And if the right side is greater than the left side, we will carry a credit balance. So many of you may have heard the word debit or credit. Like I have a debit card, or I have a credit card, or the bank credits my account or debits my account. When I say debit or credit to you, all I mean is right or left. So that is one difference that some of you may need to have a hard time accepting, because yeah, especially if you're in banking, or you may have heard those terms before, you might have a pre-existing notion in mind. But debit left, credit right. Debit left, credit right. Okay. Now, what's really interesting here is depending on whether I debit or credit an account, a specific type of account, I may increase or decrease that account. Okay. So I'm going to switch to the next slide because I like, personally, visually, I like this one a little bit better. So this is where it gets a little bit confusing for students, because let's see if whoops, sorry, I just made you all bigger and I didn't mean to. Oh, well, let me try that again. Okay, so I'm going to try and draw a little squiggly line right here. So remember, we've got our basic accounting equation, assets equals liabilities and equity. And what do we have here? This is the left side of the accounting equation. I'm not very happy with my little marker. And this is the right side. Okay. Debit left, credit right. Debit left, credit right. I'm not sure how it's showing to you all. So on the left side, you see assets. Now, assets increase with a debit. Debit left, assets on the left side. If I want to decrease an asset, cash, supplies, inventory, accounts receivable, I will credit that account. On the other side of the accounting equation, on the right side, if I want to increase a liability or equity account, I credit those accounts. So accounts payable, salaries payable, taxes payable, something we owe. If I incur one of those, I'm going to credit that account to increase it. Same with common stock and retained earnings. So I might recommend, if you're not too familiar with debits and credits, that you print off this slide to have available to help you when you're doing your homework or taking your quiz, just to help you kind of cement those. I'm going to give you a little learning aid in just a second. Now, if we come back down here to dividends, revenues, and expenses, that's used in calculating retained earnings. So liabilities, common stock, retained earnings all increase on the right side. They're on the right side of the accounting equation. And in order to calculate retained earnings, I take my revenues minus my expenses minus my dividends. So revenues increase with credits, but expenses and dividends will increase with a debit because they decrease my equity. So they kind of act like an asset in that aspect. So one way to help you remember that is this AID, ADE. So think learning aid or lemonade. I have a picture of there. So if you just remember AID, ADE, assets, dividends, and expenses all increase with debits, which is the DE portion that you see there. Assets, dividends, and expenses all increase with debits. On the flip side, you can do LCR, or you just remember everything else will increase with a credit. LCR stands for liabilities, common stock, revenues, and retained earnings, and those increase with credits, hence the CR portion of that. Another way to remember is down here, it's kind of hard to read, but after eating dinner, let's read comics. So you get your AID and your LCR. Also, I have a little video to help you remember. Debits and credits. It's called the debit and credit theory. And let me play it for you. Just send me a message or holler if you can't hear it. I always have trouble with the audio when I share a video. Oops. Sorry, I thought there was an option here to share an external video. There we go. Like I said, holler at me if the audio is bad. I'll see what I can do. Okay, great. If you click on the audio icon on the browser, it helps.
I already love this.
Sounds like fun, son, but you gotta walk before you can run. To know what these numbers mean, you gotta know the debit credit theory. Debit on the left, credit on the right, debit left, credit right, debit left, credit right. For complete satisfaction, balance all of your transactions. Debit on the left, credit on the right, debit left, credit right, debit left, credit right. For complete satisfaction, balance all of your transactions.
That's you guys, right? You're like,
oh. So, if you really want to know about your cash flow, where your money go, then give in to the temptation. Understand the fundamental accounting equation. An asset increasing is a debit. An asset decreasing is a credit. The reverse is true for liabilities and equity. If you get this, then you get accounts. Debit on the left, credit on the right, debit left, credit right, debit left, credit right. For complete satisfaction, balance all of your transactions.
everybody.
Debit on the left, credit on the right, debit left, credit right, debit left, credit right.
I know.
Complete satisfaction, balance all of your transactions.
That's how you're gonna leave tonight. Awesome. That's it. Okay, you can't forget, right? You have that emblazoned in your brain now for the rest of the. What happened? That's not what I want to do. Why did it not go back? Whoops. No. Stop sharing. There we go. Okay, great. Yeah, hopefully you don't forget. That's the purpose. And Jasmine, you mentioned your 10-year-old. I know my daughter knew her ALE. What goes on a balance sheet? Assets, liabilities, and equity. Those are really good things to start teaching your youngins. So at the dinner table tomorrow, you can be like, guess what I learned? Yeah, the link. I can post it again. It's fine. Okay. So again, don't forget assets or debit left, credit right, debit left, credit right. Okay. So in accounting, we have something called a double entry accounting system. So every time we analyze a transaction that impacts a company's assets, liabilities, or equity, we're going to record that. And we need at least two parts to every transaction. And if we do it correctly, our accounting system will miraculously work perfectly. So the steps are, we have to analyze each transaction. We have to record those in a journal. We post that information into a ledger, and then we prepare something called a trial balance. And that's where we will stop for the evening. So those 4 steps, one more time, a little redundant. So the journal is just where we record all of our transactions. So it's one location where we will keep place chronologically of the transactions that impact our business. And when we write a transaction into the journal, that's called journalizing that particular transaction. And what it looks like in the journal, you'll see we've got a date column, we've got a column for the account titles and explanation, a reference column, and a debit and credit column. So the debit and credit column makes it really easy to see. You can see my debits equal my credits, and that's really important. For every transaction we make, your debits have to equal your credits. So when we put it in the journal format, it makes it very easy to make sure. Now we can have more than 2 accounts impacted, but we have to have at least 2. And you'll see here, you report the debit first, and then we record the credit. Don't want to jump ahead of myself. And we like to leave a space in between and give a little explanation, but you don't have to worry about that in this class since we're doing it automatically in software. Here's an example where we had just 2 accounts. Here's one where we have more than 2 accounts. We always list the debit first and then the credits. And interestingly, look here, we have 2 credits, but if we add them together, they equal 14,000, which is the amount of our debit. So that's important to remember. Your debits always have to equal your credits. The debits get listed first. And I can't say a debit increases all accounts because it doesn't. It may increase or decrease an account. It just depends on what type of account. Remember, debits only increase assets, dividends, and expenses. This would be incorrect. So watch this when you're doing your homework, because I have students sometimes that email me, you can't list a credit and a debit and a credit. You always have to list the debits first and then the credits. So watch that. Even though you think it's technically correct, it's not. And then once we put our transactions into the journal, we post into each individual account what transpired. And we call that a ledger, where we keep track of all of our individual accounts, asset, liability, and equity accounts here. So let me show you what I mean. So for example, in this transaction, we had a debit to cash. So my cash went up by $15,000. And I had a credit to common stock. My stock went up by $15,000. So we take that transaction and I go find my cash ledger account, and I'm going to copy that. So I will carry down the $15,000 from the journal into the ledger, just copying. I did the hard work with the journal. Carry down the date. Calculate a new balance. You'll see here. Take this page number from my journal, and I will write that in the reference column of the ledger. So if I have a question about this transaction, I know it's on page J1 of my journal. I can go back and find it. And then lastly, take the account number from cash, and I will write that in the reference column of my journal. That tells everyone that I have posted that transaction, so it should appear in the ledger. I would do the same thing with common stock. I go find the common stock ledger account, carry down the 15,000 credit, just copying it down, recalculate the balance, carry down the date, account number 25, I write in the reference column of the journal, page J1, I will write down here in the reference column. Now you can do all of the journal entries and then post to the ledger, the end of the week, the end of the month, whatever it might be, or you can do a journal entry and do the posting as you go. However you want to do that. Okay, so here's finally where you guys get to start contributing here. Transaction analysis. We're going to analyze a number of transactions. So we need to know what kind of accounts are involved, what type of account it is the balance increasing or decreasing? And that will tell us, do we debit or credit the account? And then we record it. I like Carlos. This information is important for the first assignment and quiz. I bet it probably is. You're right. I've tried to narrow down my lectures to only give you the information that you need for either your assignment or quiz. So first transaction we have investment of cash by owner. So you see the transaction there. on October 1st, C. R. Bird invests $10,000 cash in an advertising venture to be known as the Pioneer Advertising Agency. So I need everybody to think about what accounts should be involved. And I have a slide here. So this is basically the ledger. So in blue, I have assets, cash, prepaid insurance, advertising supplies, and I can't see the other one. It's covered up on my screen. Liabilities and equity. We've got notes payable, unearned fees, accounts payable, salaries, expense, rent expense, dividends, common stock revenue. So this would be the chart of accounts, the accounts that we would use for this particular company. And here's where you get involved. If you can, I'm going to see if I can turn on the whiteboard. Okay, there we go. So some of you are already on. I would like you to put a check mark or an X or a slash, something where you think the debit account should be and where you think the credit should be. So which account should we debit when C.R. Bird invests $10,000 of cash in the advertising venture to be known as the Pioneer Advertising Agency? And which account do you think we should credit? Because we need two. And think about back to our debits and credit song. Assets, dividends, and expenses increase with debits. Liabilities, common stock, revenues, and retained earnings increase with credits. And hopefully you can use your finger or your mouse, and you can. Okay. Looks like we've got a lot of you hanging around the cash debit, which is good. That's definitely correct. The question is, what's the credit then? I don't see too many credits. I love the smiley face. Yes. Okay. So I'm going to tell you, yes, this is right. We will debit cash. And you can see the little increase there. I put them there to help you see which increases, which decreases. What else is happening there? What do they get in exchange for their investment? Any of you have investments in companies? What do they give you? They're not going to give you supplies. Dividends. Hopefully. How do you get dividends, though? They don't just give you dividends. They give you dividends. Why? Yeah, and some of you figured it out because you're a stockholder. So we want to credit common stock. Okay. So our journal entry, for this transaction would be a debit to cash. Cash is an asset. Assets increasing. So my asset cash is going to go up by $10,000. And in exchange for that investment, we're going to give that person $10,000 in common stock. So then we would post that, and you'll see here, this isn't like the ledger that I showed you before. This is a T account ledger. Oh, I need to take that fat thing away. So this is our T account ledger. So the cash, we have increasing on the debit side, hence the $10,000, and then a credit to common stock. I might also show you real quickly. I'm not going to do them all because it takes too long. Let me share I'm going to put this on a different screen. Okay. Alrighty. I don't know. That looks way too little on my screen. Can you guys even see any of that? It's like flashing weird too.
It's flashing weird for me too.
Okay. Well, let's stop that. Let's try it again. If not, it's not imperative. Okay, it's not flashing, but it's very small. How about on your end?
Small.
Okay. Okay, forget it. I was just going to show you in Excel, basically that same slide that I was showing you a second ago. So we'll cancel that. And I'll have to figure out why it's so teeny tiny. Strange. So back to what I was saying, this will be a T account. So we would take the journal entry and post it. This is the ledger down here. So we post, meaning we copy from the journal into the ledger. Okay. Questions on that step? Because we're going to do like 8 of these. We're going to do a lot of practice. Okay. Let me post. Here's the next one. We purchased office equipment. So on October 1st, are we, let me go back because quick question. Because we are investing, credit would be common stock. Okay, good question.
Mm-hmm.
I didn't think I would have to go back so far, but it's okay, I will. Here we go. So the reason we did a debit to cash was because my asset cash was increasing. We were given cash, and anytime you receive cash, your cash account goes up. Anytime you pay cash, cash would go down. Cash is an asset. It's something we own. So hence I need to debit the cash account. And then if we come over here, my common stock went up. And the only way to increase common stock is with a credit. Also, my debits have to equal my credits. So if you do accounting correctly, it always miraculously will balance like that. You'll have, and this stays in balance. This is a requirement as well. Now I can have one asset go up, one asset go down because it's on one side of the accounting equation. But in general, this accounting equation has to stay in balance. So let's go ahead and we'll do another one. And it takes a lot of practice. Again, that's where I said repetition and practice is the best way to learn accounting. It's not intuitive, right? You don't automatically know, oh, I need to debit mine. It takes a long time for that to settle in. So here's the second transaction. On October 1st, office equipment costing $5,000 is purchased by signing a 3-month, 12%, $5,000 note payable. So again, you all can come on in, put your little stamp on where you think the debit should be and the associated credit. We purchased office equipment. We did not pay cash. I'll give you a hint. We signed a 3-month, 12%, $5,000 note payable. And I put little arrows. I don't know if you can see it. It might be kind of small to help you see which accounts increase and decrease with the debits and credits.
Do you have to do something for us to have our...
Oh, do I? Let me, yeah. Maybe I do. Does that help?
Yeah.
Okay, sorry about that. I thought it would automatically stay on, but I guess not. Sorry about that. Oh boy. Okay. So that must be equipment. Well, what's happening with our equipment? There's some discrepancy going on. I see some debits, I see some credits. If we buy office equipment, would it be going up or would it be going down? Equipment is increasing, yeah. So we would have to debit that. Equipment is an asset. It's in blue. So the only way to increase equipment will be with a debit. So we want to definitely, I'll say we want to do this. We want to debit our equipment. So now we've got one side of that. We know we are going to at least need a credit. So where is the associated credit? And wow, you guys zeroed in on that right away. We would credit notes payable. Notes payable is a liability. It means we took out a loan, and it says we took out a notes payable. And the only way to increase liabilities is with a credit. So we have a debit to equipment for $5,000 and a credit to notes payable. And again, remember, we will indent the credit. Maybe I didn't mention that. I'm going to make sure I do. You always indent the credit, and it kind of parallels these two columns here. So the credit is on the left side, the right side. And so our notes payable will be indented just to the right a little bit. And then we have to post that by recording it in the office equipment ledger account and the notes payable. Carry that down, write the date. Questions? Yes, assets are increasing. Great. Okay, let's do another one. I'll just go to the next pipe. So on October 2nd, a $1,200 cash advance is received from Arnox, a client, for advertising services that are expected to be completed by December 31st. So they're giving us money in advance for future services. We're going to give them some advertising in the future. We're going to get cash now, and then we have to provide a service. All right, you guys, perfect here with the debit to cash. Remember, anytime you receive cash, cash is an asset. Assets increase with debits. What's the credit then? Looks like some of you said advertising supplies, but I think most of you are good down here with the credit to unearned fees. That's right. So that's a liability. It doesn't have the word payable, but it's unearned. We now have an obligation to provide the service. So that's correct. So we debit cash for $1,200, credit unearned fees, $1,200. And then we go find the cash account and we would record that debit. So my new balance in cash would be $11,200, which it's not showing. And then we find the unearned fees account and we will go ahead and record that. Questions? Okay, good. Let's do a handful more. Questions about the process, anything like that is good too. Yes, awesome. Okay, let's do some more. Payment of monthly rent. On October 3rd, office rent for October is paid in cash, $900. You are paying cash. You're paying your rent, basically. How do we want to handle that? Oh, pen, sorry. You are all quick learners. Awesome. Yes, you're right on it. So cash is going to be credited because my cash goes down. And then my rent expense is going to be debited because my expenses are actually increasing along with that. Now, the expenses will technically decrease my equity, but it's increasing the expense itself. So we have one debit, one credit. Cash is when we credit cash, because it's an asset, that means I'm decreasing my cash. So we've made a payment. You know, when you pay something, cash will go down, and hence the credit to cash, which is an asset, and our expenses are increasing. So we're going to debit. Remember, aid, asset, dividend, expense, increase with debits. So we debit expenses for $900, credit cash for $900. So I have 3 postings to my cash account now. 2 of them increase the balance. Now I have one that's going to decrease that balance. Keep going. On October 4th, $600 is paid for a 1-year insurance policy that will expire next year on September 30th. We paid $600 for a 1-year insurance policy that will expire next year on September 30th. Awesome. You guys are all over it tonight. Cash credit, prepaid rent, debit. So my prepaid rent, which is an asset, is going to be increasing, and my cash is decreasing. Whoop. Hence the credit there. Maybe I make it a little smaller line next time. So what that looks like, a debit to prepaid insurance. And again, don't forget the cash credit will be indented to reflect the cash journal entry. And then we record the journal entry when we post it into the ledger. Just copy those into the appropriate account. Okay, a few more. Purchase supplies on account. October 5th, an estimated 3-month supply of advertising materials is purchased on account from Arrow Supply for $2,500. We purchased a 3-month supply of advertising materials on account from Arrow Supply for $2,500. We did not pay cash. We purchased them on account. Okay, looks good. We have a debit to advertising supplies. So when I make that purchase, I'm going to bring in supplies. So my supplies are going to go up. Supplies is an asset. And again, we didn't pay cash this time. So we are incurring a liability. We now have an obligation to pay for those supplies, and we call that accounts payable, hence the credit. Now that's also increasing because liabilities increase with a credit. So we debit the advertising supplies, credit accounts payable. Again, supplies is an asset, accounts payable is a liability. Both of them are increasing in this case. Questions? Okay. We're making really good progress, gang. We'll be done in, another 15 minutes probably. Hiring of employees. On October 9th, we hire 4 employees to begin work on October 15th. Each employee is to receive a weekly salary for a 5-day work week, payable every 2 weeks. First payment made on October 26th. I'm tricking you because we just hired them. This is the 9th. They haven't even started work yet. They don't start work until the 15th. So there's nothing to record because they haven't even started work. We don't owe them anything. That is a non-recordable transaction. So, keeping you on your toes. Let's try another one. On October 20th, C.R. Bird pays a $500 cash dividend to stockholders. We are paying a $500 cash dividend to stockholders. What happens when you pay? Is your cash going up? Cash going down? I'm guessing a lot of you right now just want to like, nah. So yeah, anytime we make a payment, cash is going to be credited because cash goes down and cash is an asset. So the only way to decrease our cash is with a credit. So we know we have a credit to cash. The debit, you guys picked up on that, is a debit to dividends. Again, the dividends increase with the debit. Remember, aid, asset, dividend, expense increase with a debit. Here's what it looks like if we were to put it in the formal journal entry, debit to dividends, credit to cash. And again, we take that journal entry and we post it into the individual ledger account. One more, maybe two. Those employees that we hired, they did show up, thankfully. We owe them $4,000 and we're going to pay them in cash. This is October 26th. Wow. Okay. Everybody says credit cash. That's right. Anytime you make a payment in cash, you're going to credit the cash account because cash is an asset. The only way to decrease cash will be with a credit, and debit salaries expense because my expenses are increasing. We increase them with a debit. Perfect. Debit salaries expense, credit cash. You can see the amounts. Go ahead and record them then into the ledger. One more. Asset decreases with a credit. Yes, that is correct. Sorry if I missed that a minute ago. Final question for you guys. Let me turn on the October 31st, we received $10,000 in cash from Copa Company for advertising services rendered in October. Ooh, we received cash. Yay, I like that. For advertising services. Okay, so you guys are good here. Debit to cash, because cash is going up. Cash is an asset, increases with a debit. Where's the credit, though? We provided service. Now we get to, what do we call that when we provide service? Okay. So notes payable, accounts payable, and unearned fees are all liabilities. That means we would owe something. And in this case, we've gone ahead and we provided the service. We don't owe them anything else. So in this case, now we get to go ahead and recognize the revenue, which is down here in the corner. And by crediting our revenue account, that actually increases that particular account. So that's how we remember revenue minus expenses. So we're actually increasing our income here. It says fees earned. I think I had it as revenue. That's another way to say revenue, fees earned. So debit cash, 10,000. Cash goes up for those services we provided. And then our revenue on our income statement is going to go up by the 10,000 as well. Any questions on any of those transactions, the process, asset or debits, credits, assets, liabilities? And again, don't get frustrated if it's not like immediately, if it's taking you a minute, that's fine. It takes time, especially if you've never had accounting before. Yeah, so the trick question, I don't even think you'll ever see one again, but let me just show you why. So the transaction was dated on the 9th, but they don't even start work until the 15th. So in that particular case, they haven't even come to work yet. They might not show up, so we might not owe them any money. That was just the trick, I guess, for that one. You had to look at the date of the transaction to figure that one out. But again, I don't think you will ever see a non-recordable transaction again. So don't get too concerned with that. Oopsie. Okay. Very last thing of the evening. So once we've analyzed our transactions, we've recorded the transactions, or what we call journalized them in the journal, posted them into the ledger accounts, we prepare something called a trial balance. And this is getting us ready for the end of the reporting period to kind of close up all of our accounts. And we want to make sure all the work that we've done up until this point, looks like we've completed it successfully. I'll show you in a minute. It doesn't mean we have, but we want to kind of at least do a preliminary check to make sure it looks like we've done our work properly. And I will tell you, when I was in college too many years ago, when I first took accounting in high school and in college, we did it on paper. And, I would turn in my paper assignment to my professor and he would manually grade it. You don't have to worry about that because you'll get instant feedback in my open math. But back in the day, I really appreciated that because I, in many cases, would know if I made a mistake before I even turned in my homework so I could go back and fix it. So here's the trial balance. You go to your ledger, okay, where we list out all of our different accounts, and you find the ending balances of all of those accounts. So cash had an ending balance of $15,200. Advertising supplies, you add the debits, you subtract the credits. Whichever side is bigger is your balance. You probably should have made that a little bit clearer. Let me just give you an example real quickly. I can't write well, but let's say this was cash. And I have $1,000 in my cash debit. So unhappy. And a $200 credit. So $1,000 debit and a $200 credit. That means I would have an $800 debit balance. Whichever side is larger, you subtract the other side, and that will give you a balance on that particular side, just to show you how we calculated those balances. So we list out all of the accounts in our ledger that have a balance. Just list them straight out. And then you just copy whatever balance they have. You put it in the appropriate column, either in the debit or the credit column. And then we're going to add up the debit and credit columns, and they have to balance. That's why it's called a trial balance. The debit column has to equal the credit column at this point, or you made a mistake. So one more time, really quickly, you go to your ledger, you list any of the accounts that have open balances, meaning anything above zero, have a balance more than zero. And then you just copy from the ledger whatever the ending balance is, either a debit or a credit. You write it in. Then we add the debit column together. And then we add all these numbers in the credit column together. And they must equal. If they don't equal, you made a mistake. Okay. The only reason we prepare a trial balance is to make sure my debits equal my credits. So here's some limitations. I said to you a minute ago, just because your debits equal your credits does not mean that you did everything correctly. The reason is we may not have journalized a transaction, not even recorded it. Or maybe we didn't post it from the journal into the ledger, or we recorded it twice, or we used the wrong amounts or the wrong accounts. So just be aware that even though it looks correct, it is possible it could still be wrong. If, though, your balances don't equal, there are some things you can do. You can re-add your debit column and your credit column, make sure you added them correct. That would be the first starting point. Go back to your ledger then and make sure you carried over or recopied those numbers correctly. Make sure that you didn't put something in the wrong column where it should have been a credit and you put it in as a debit, back and forth that way. Recompute your balances in the ledger. Make sure that we posted every entry from the journal into the ledger, and make sure that our original journal entry has debits and credits. Again, I've been doing this for a really long time. And one of my jobs in college, I worked for a pharmacy, and I was doing his books. And if you have an error, it can be really hard to find. Computers make it a lot easier these days because it's probably not going to allow you to even enter a journal entry that doesn't have proper debits and credits. But as you're learning the system, we're teaching you the basic fundamentals, you might find that it could occur. And then again, back to that accounting cycle, we will finish steps 5 through 9 because we won't do 10 next week. And that's really it. Any questions for me before I let you go a few minutes early? Awesome. We look good. Okay, everybody come back next week. It's great to see your smiling faces and hear your questions. And maybe Taylor.
Oh, I
Tell
have
me that. Pardon?
I have, earlier you said that for the quizzes, we can go in and copy it and work on it through the week. Did I hear you correctly? So you just go into the quiz and
So
open
I don't think you can actually print.
them.
You can't really print from the quiz from within Canvas,
Right.
but you can highlight it, I believe, just like you can a Word document, and then you could paste it into Word and print it from there. And yeah, you could print it on paper, and then when you're doing your homework or in class, when I'm talking, you could kind of familiarize you and start circling them as you go, so you can fill them out as you go. That's how I would approach it anyway, rather than, like I said, wait until Sunday at 10 p.m. and try and scramble to get through them.
So then there's no time associated with the quiz. So if you open it, you can open it again. Okay.
Yeah. The only issue would be the due date, that it's submitted by the due date. Mm-hmm.
Right.
Otherwise, there's a late penalty. You can even submit it late. There's just a late penalty.
Okay.
Awesome. Alrighty, gang. You guys have a wonderful evening. Go enjoy what you can, what's left of it. And I will see you next week, I hope. Don't hesitate to ask me any questions that you might have. It's great to see you all.
Everybody have a safe trip back to their couches.
Yes.